Yeah, you can go now.
Hello, everyone. This is Joseph Trevisani from Worldwide Markets. Welcome back to our webinars through FX Street. It's been some time since we've had one. So I thought we'd start on a topic that it seems to me to be key and core to all that we're doing. And that is the question of inflation, interest rates, deflation, and around the world. Everyone should see, we're using a new system here. We're using a Google system. I think it's a Google Hangout. So we're both a little unfamiliar with it. So give us a little leeway on that one. You should see a chart of worldwide inflation from 1970 on. And I'm just going to start from there, okay? So the title of today is Inflation and Deflation, and of course, central bank interests. Now, if you have any comments, anything you want to add to it, please type it into the chat. I should see it. It's right in front of me. So I'm counting on that I'll be able to answer your questions as they come through. Although I do have my doubts that will happen. We'll try, and hopefully we'll get there, okay? So we're going to start from the history of inflation, very briefly. What it is has happened over the past, not only generation, but also a little bit of historical perspective on it. Then we'll talk a little bit about the theory of why it is that central banks are so terrified of deflation. Whether that is, in my mind, now remember, this is not the central bank's opinion, it's my opinion, whether that's a sort of a realistic view. And then we will get to what we're all most interested in, and that is, of course, the current inflation situation, the current central bank situation, and where it is that policies, both on inflation and on other things, might be taking us. So to start, it's very hard to find. I looked for a very long history chart, and it's difficult to find. But this is inflation in the developed world. And I'm focusing on two aspects. The developed world, largely because that's the best documented. And two, its central bank policies are the only ones that really have any effect around the world. And it's the developed world's economy that drives the world economy, of course. And then later on, I will focus more specifically on the United States and Japan. The United States, because it is still the largest economy in the world, and in all essences, the Fed is the central bank for the world. And Japan, because Japan is the great example. It's all out there for everybody to see, for all the central banks, about the limits of effective monetary policy in the face of many, what apparently are stronger trends from other parts of the economy. So, a little bit of history. I couldn't find the chart, but if you look at a very long-term view of inflation, say back to the 15th century, you can do this in Japan, I believe, because of rice prices, which Japan never was really invaded for more than 2,000 years. The records are still there, and you can also get a pretty good record of it from corn prices in Britain. And what you see on that very long historical trend is that for very long periods, prices were essentially stable. They didn't move very much. If your parents paid, a pound for a bushel of corn, your grandparents probably did too, and your children probably would as well. There were periods, of course, of inflation. The Romans saw this, and many others did as well. And they were largely what we would call central bank creations of the monetary authorities. For the Romans, what they would do is, when the empire would start to run low on cash, especially in the later days, they would debase the currency. People caught on to that very quickly. So if a denarius was composed of a certain amount of gold at one point, you drop that down, you debase the currencies, and guess what? Everybody figures it out almost immediately. and prices go up. You don't gain anything by doing that. Okay, I'm just making sure here that the chat window is open so that everybody can see what is going on here. Well, I hope so. Okay, so let me continue. You get a similar project from central banks and their interest rates, essentially debasing the currency. Okay. With the historical record, which is what we're looking at here, there's a pretty large congruency of all worldwide inflation rates, as you, I suppose, would expect. Well, what is the other striking conclusion you could draw from this chart? It's quite obvious, obviously. Everybody can see it. Everybody knows it. Inflation rates have been on an almost 40-year decline. If you look at the US rates, they peaked about the 80s, Japan in the mid-70s, and they've been declining ever since. Central banks have taken a great deal of credit for this. There are possible other arguments for it, but we can just go with that one right now. That the center, what they did, and this was the monetarist theory, the one we're still following. You know, I sometimes think that monetary theory works a lot like the difference between Newtonian physics and quantum physics. For Newtonian physics, the rules that apply have a limit. When you get to very, very small dimensions, atomic dimensions, they no longer apply. You enter the quantum world, which is a very strange place because it doesn't operate on rules that make sense to our senses. If you throw something and you push on it, you can feel the resistance. You know it's going to fall. It makes sensual sense to a human being. The idea that a quantum particle or a quantum force can be in two places at once makes no sense. Theoretically, it makes sense, and it seems to work as far as predicting actions and events on a subatomic level. You have a similar idea, I think, with interest rates, the theoretical extension into negative interest rates. And I'm going to draw that analogy firmer in a few minutes. But right now, we have the historical view. It seems that the central banks viewing inflation as a terrible thing. I mean, you know, the inflation images that, of course, come back are the inflation, and you type in hyperinflation on the web, you always get the same picture. It's that picture of the Weimar inflation in the 1920s in Germany and buying bread with a barrel full of paper money. That type of hyperinflation is uniformly the product of government policy, printing money, basically. You saw it in Zimbabwe. You've seen it in a few countries around the world. It is always uniformly, every time, the product of a government policy, of a central bank policy of debasement of the currency. So it is not the standard result of a particular type of price cycle in capitalism and overheating of the economy and anything like that. When you get that kind of hyperinflation, it is a monetary phenomenon created by the government. Now, the great fear of central banks these days has been deflation. And as you can see, now you don't have a chart here, but let me get I have a longer chart here. Now, bear with me because this is a new system. Okay, now this should work. I want to bring up a new chart. It's not quite as fast as the old system. Okay. Now everyone should see a chart of U.S. inflation from, let's make sure we've got the chat open here. Okay, just want to make sure that everyone, the chat is moderated. Okay, everyone sees it, good, okay. And you can see from this chart the phenomenal rarity of deflation. Did it? I mean, all central banks are terrified of it. But here we are, the only real tangible examples. Now, the period in the 1920s, but primarily 1930s, which is the one everyone cites. The reason central banks are so obsessed with it is because they've all come to the conclusion that the deflation in the 1930s was a result of bad central bank policy, of restricting the money supply, which created this decline in prices. In my view, this is, and I take full credit for this, even though I'm not an economist by training, that view has led us logically to where we are now. Monetarist policy, let's go back to my prior analogy about Newtonian and quantum physics. Monetary policy is a Newtonian world. If you raise the interest rate, you will tamp down the economy. If you lower the interest rate, you will boost it. Essentially a linear reaction to the cost of money. And so that led central banks to the very obvious conclusion, as far as inflation rates go, that if you keep rates high enough for long enough, you will, and this is what Paul Volcker did in the 1980s, you will squeeze inflation out. Once you squeeze inflation out, you change expectations. People don't demand wage hikes as much, and on, you create the cycle that we've led to. And the logic, of course, worked very well. I believe I have a chart here of break-evens on the, let me see if I can find it here. Again, bear with me, sorry about that. We're a little bit slow on this new version of our system here. You know, it takes a little bit of time to get used to it when you're trying to switch switch charts very quickly. Let's see if I have that break-even chart here. All right, we're going to stay with this one for a minute. I don't want to take too much time from the discussion. So, as the central bank squeezed out inflation, the logic held, and you can look at, let's look at another chart here. Hold on. Oh, here it is. I apologize. Here we go. Okay, hang on. Back to Google Hangout. Back to this. Come on, dude. Hold on. Okay, here we go, break-evens. Okay, you should have the break-even chart up. Let me go back to the chat to make sure. Okay, this is the break-even chart. This is also about quantitative easing, but it's the break-even. You're looking at the 5-year inflation rate break-even rate. Okay, now this gives you a sense of the dip in, not prices, of course, we're talking about break-even, but the break-even rate reflects, of course, prices in 2008 when we dipped inflation. One thing you have to remember about, of course, on all charts that involve year-on-year figures is the base effect. So when you get a period as you have in 2008 through here, does everyone see my arrow on the chart? I'm just not sure if the system picks it up. Anyway, when you see the decline in prices like that, the period immediately after the decline, of course, you're going to see an increase in whatever the rate is, simply because it was falling at a prior rate, a prior time, and now it's rising. So even though you have this great fascination, if you will, with interest rates, as a cause, as a preventative for inflation. It was tied, of course, with Alan Greenspan's contention that the business cycle could be tamed through the advent of enlightened monetary policy. I think, if anything, we've been taught that that absolutely is not the case. Nevertheless, the logic for central banks, and they've been successful at this, and they're certainly going to take credit for it, is to remove the danger of inflation. But if you look at a chart of inflation, and let's pull up another one here. So let's see, CPI World US, let's check this one out. Okay, here's a good one. Here we go, Google Hangouts. It's a two-step process here. Okay, we should have, oops, come on. Here we go. Hey, it's starting to work, cool. This is US inflation and world inflation. The chart looks a little skewed because if you go back to world inflation back in the 1990s, I don't know exactly where they're getting these numbers from. I think it's OECD. But at some point it's registering 40%. I don't know exactly what they're talking about, frankly. But let's just take the normal skew between inflation from, say, 2000 now and 2000 in the United States. And you can see that even in the world, with lots of chance in developing economies, in economies not so well managed, shall we say, and sometimes I'm being facetious with that. Let me just pull on chat again. That inflation has been tamed by, if not the central banks, then something else. But inflation has been tamed. So now that we have that, as a result of central bank action, the question has to be, and let's go back to the prior chart here. Let's see, which one do we have here? This one. Now, can everyone see the break-even chart? Let me check to make sure that it's up. No, let me fix it. Break-even chart. There we go, cool. Okay. Why do central banks fear inflation, fear deflation? We have to answer that question first, I think. From a consumer point of view, we all live in consumer economies, except China, which is largely an industrial economy. I don't mean except China, but China is a much more industrial economy than the United States is. What is the terror of deflation? Oh, one other thing, let me define this. I skipped that part, excuse me. There are three types of price changes, obviously. Everyone knows this, let me just go through. We have inflation, rising prices. We have disinflation, which is falling prices, but still a positive price change. And then we have deflation, which is an absolute negative change on the prior period. Inflation from the 70s ruled. Disinflation, let's pull up a chart here to give you a sense of that. This one right here, that's not a good one. So let me pull up another one. Okay, this is, let's find a good one here. Let's do one from a different venue. Let's try Japan. Okay, this is Japan. Going to be one of my later examples, okay, of Japanese inflation, deflation back to the 90s, okay? So this period here, and most of the time we have disinflation. Now, Japan is an example of actual deflation. So disinflation is what we've experienced since the late 80s, a declining rate of price increases. Except for brief recessions, it doesn't really dip into deflation at all. Japan is an example of persistent deflation, persistent falling of negative prices, cheaper than the year before. Now, why do central banks fear this so much? It would seem from a consumer point of view, this is not a bad deal. Bank accounts are worth more. It's difficult for loans, but there's a balance. It would seem that there's a balance between negative effects and positive effects. Central banks fear it, or so they say. The logic is, and the logic never really is fulfilled in my mind. It's simply explained as if it's obvious without a good theory behind it, if you want to put it that way. And the theory for the central banks is that inflation into deflation fosters a negative reinforcement cycle. That as consumers, we all start to understand, start to expect, start to anticipate a lower price in 3 weeks, and so we don't buy, and we wait for the price to come down. Now, I think there are a lot of problems with this defense of deflation as a danger. First of all, in most of the world, a good portion of income is spent on necessities, food, housing, leases, things like that. Is it possible, very obviously, bad joke, to defer your food purchases because rice is going to be cheaper in 2 weeks? Hardly. So it has essentially no impact on much spending. And even in a fully developed country or a developed world country, the United States, Europe, China, any place you'd like, most purchases are not discretionary. We just bought a new car. Why? Because the old car got totaled. Somebody ran into my wife when she was driving. Now, is there an element of discretion in that? Very little. We needed a car. We bought a car. If I thought cars were going to be cheaper in a year, would I have bought the car? Of course I would have. So the idea that deflation necessarily fosters a declining cycle of industrial production, I think is nonsense, even on the production side, because if you're going to buy in 6 months, it still needs to be produced. So it doesn't make it so if everybody waits in 6 months, if everybody in the economy needs to buy a car and everybody thinks it's going to be cheaper in 6 months, so everybody waits for 6 months. So what happens in 6 months? Everybody starts trying to buy a car. If those cars aren't ready to be produced, what's going to happen? The price is going to go up. So the idea that that deflation is necessarily a product of people anticipating lower prices, I don't think that makes a lot of logical sense. The other aspect of deflation is that it's a product of in a contractionary money supply. And again, if we follow the logic out, if there's not enough money running around in an economy, how exactly will that make prices lower? In fact, it would probably make prices higher. So that one, I've always thought that deflation as a terror has this very flimsy sort of theoretical basis behind it. The one aspect of deflation which is never really mentioned, because it's not one which can be affected by central bank action. And I think it has much more logic to it, and I think it applies very well both in 2008 and in the 1930s, 1920s. And that is, inflation is a product of two items. And one of them is demand. If people are worried about the future, that's what they do. They stop buying things. People were very worried about the future because they didn't have any money. They lost their jobs in the 1930s. They stopped buying things. Manufacturers started to lower their prices. They had no choice. In 2008, well covered. Everybody knew the world was ending, or almost. People stopped buying things. We were looking for an apartment at the time. We did not buy an apartment. We waited several years. That happens to everybody. So it's a very logical conclusion that it's the demand side that changes and is more determinant of inflation rates than the monetary side. One way that the central banks approach this, and the Fed does this, of course, is through their inflation expectations. So when they do their surveys, they ask people, what do you think inflation is going to be in 6 months and a year? And honestly, does anybody have a clue? Professional economists, which maybe is not a good group to look to for advice about the future. Certainly they haven't been very good about predicting anything, anytime recently that we've noted. Or as the Fed said in 2008 and late 2007, the subprime mortgage crisis is contained. It won't cause any great problems for the economy. Or as the European Central Bank said in the summer of 2008 when they raised rates, we have no problems in our banks from I always like to use these examples, I'm sure you've heard them before, from the US subprime crisis. So clearly, the central banks have almost no better track record than anybody else at predicting things. The Fed has been predicting inflation to hit 2% for 3 years now. It has in one chart. So the idea that asking people, you and me, and others, our children maybe, what they think inflation is going to be in 6 months or a year, and that has any validity, in my mind, is pretty nonsensical. But they do attempt to gauge inflation. What they're trying to do, of course, is not get an absolute prediction, but they're looking for a change. So if they're looking for the comparison between what people might have said a year ago, 2 years ago, and what they're saying right now. So that's sort of how they try to incorporate it. So deflation is viewed by central banks as the Great Terror, at least by the American Central Bank under Mr. Ben Bernanke. I'm sure we all have heard the story that Mr. Bernanke wrote I believe, his doctoral dissertation on monetary policy in the Depression and how monetary policy provided the wrong answer. Instead of doing what Mr. Bernanke did in the years when he was in charge of the American Fed after the financial crash of 2008, which is basically just pump as much money into the economy as possible. Because he viewed that the policy response of the American Fed in the Depression was the wrong response. Now, there is, of course, a element of you do what you can and you do what you do because you can, and that's all you can, to this entire discussion. Central banks have one monetary tool, inflation rates, interest rates. So that's the tool they go to. They're enjoined to act. They're expected to act, so they act. They mess around with the inflation rates. It doesn't necessarily mean that that's the proper answer. It doesn't mean that that's the proper problem that they're addressing. Nevertheless, it's what they do because that's all they can do. That's a rather circular logic. I understand that. It's rather cynical as well. But for most of the period, the linear relationship between growth and inflation was a fairly documented one. Empirically, it was true. Now that we're approaching the negative area, I think we're in a much different zone. Okay, so let us now approach that. Now, I just want to ask FX Street, are we on for 45 minutes or an hour today? Because I just want to judge that so I can judge how long we're going to go with this. Okay, now we're going to go to Japan. Whoops, wrong Hangouts. Okay. Okay. This is Japan, going back to 98. And I'm going to do this in the United States as well. So central banks are working on both managing prices, price changes, and in the United States, but it's true around the world. They're expected to promote, and it's worse than promote, they're expected in a way to guarantee economic growth. And here is where we enter sort of into the netherland of not just economics and monetary policy, but also in politics. But first, let's deal with the monetary policy aspect. Okay, this is a chart of Japan's current, they're calling it QE on this, and what they mean is that it is money that Japan has spent to try. And I remember sitting, my training as a currency trader, and I was I worked the Tokyo shift out of New York, and then also out of Asia, which is of course a daytime shift in Asia, for quite a few years during the late 80s and the early 90s, well, the 90s actually. Let's pull up that chart so we can have a better view of that. Excuse me one second, let me just find that chart. Okay, here we go. Come on, Microsoft. It is in a way a shame that Microsoft is the standard. Okay, now this is where we can, let me just check the chat here. Okay, so everyone should see a chart of Japanese inflation, the Nikkei, and the red line for the zero rate, which it relates to the inflation rate, not the Nikkei, of course. So, in Japan, now this goes back to 1975, and I did this deliberately. The inflation rate has been flirting with deflation, certainly since 2000, and even back to the late 80s. What happened in Japan, I'm sure you all know the story. The Japanese had an enormous property and equity bubble. It blew up. It's never been back since then. This is a chart of Japanese inflation and the Nikkei. The Nikkei 225, the main Japanese equity index. Inflation in Japan has been permanently disabled, it seems, no matter what the Japanese do. Now, I have a chart here, let me just find it, of this with, yes, cool. This is even better. Let me just bring this one up. Okay, everyone should have a chart of the Japanese overnight call rate, their basic interest rate, and a Japanese inflation rate. Japan has been suffering some type of deflation and deflationary problems since the late 80s, early 90s. As I said, I would be sitting on the trading desk in Singapore, and anytime through the 90s, and Japan would open, and the Bank of Japan, Japan has a bank debt close to 300% of GDP. Everybody says it doesn't matter because it's all held locally in Japan. I think that's enormous nonsense, and I'll tell you why in a minute. Okay, so, Adindo, would you let me know whether we're on till noon here for another 20 minutes? Because I have a couple of things I want to cover, and I want to do a summary before we get to the end. Throughout the period of the 90s and well into the 2000s, the Bank of Japan and the Japanese government were incessantly, forever, stimulating the economy. Look at the Japanese interest rate. It dipped down to zero about 1999. And except for a very minor brief period above it, it's been zero essentially for close to 20 years. It's been below 1% since 1995. That's 20 years. Look at the inflation rate. This is why all of the deflation discussion, the inflation discussion, is so, to my mind, academic. If you want to know whether low interest rates work, here's your chart. If you want to know if low interest rates stimulate an economy, please, I'll send you this chart. You can get it. I mean, you can just look and see it doesn't work. It hasn't worked in the United States. It's not going to work in Europe. Anytime you assume a one-input equation, it's guaranteed to be false when it's attempting to describe actions in the real world. My niece ever heard me say that. My niece goes to MIT, and if she ever heard me say a one-input equation, she'd probably take me to task for it, because there isn't really actually such a thing. Anyway, the view to this type of policy and chart is a constrained view, meaning, now these people, no, I'm going to deal with that. I'll tell you that in a second, why I think the policy is incorrect and what I think the Fed's going to do. It's a good question, though. The question is, do higher rates make it worse? No. Remember what I said. The other side of the inflation question, I'm going to assume we're going on for another 15 minutes, just for anybody from FX Street who's listening, so that's where I'm going to go. If that's different, somebody type into chat and let me know. Again, this is the first time we've done it with this particular system, this Google Hangout system, which in many ways is easier to use because it's pretty much self-directed as far as the system goes, but we're all kind of getting used to it. So it's a little bit choppy as to when I switch around. Interest rates, clearly, without going any further, without drawing any theoretical, without becoming a math major, which I'm not, interest rates are incapable of generating inflation at this level. In an economy in Japan's situation, it's just clear. Now you can say other economies are not in Japan's situation, so it's still going to work. Okay, fine. I have an argument for that one too. But right here, just looking at China, at this, we're seeing now. Remember, when you look at this period right here in 13 and 14, right? That's when Mr. Abe was pumping up trying to pump up the inflation rate, dropping the yen, 20%. And yes, you got a blip in inflation. But what happened? Where are we now? We're right back a year and a half later, 2 years later, Japan is right back to zero. That has to be incredibly disheartening. But it's a lesson for central banks around the world that they seem impervious to learning. Let's continue. So when you have that situation, what the problem is for Japan is the demand side. There isn't any sustained demand at the level that there was before. What happens as a society ages? Well, you stop spending so much, or you shift your money to medical expenses, but the general consumption declines. Japan has a rapidly aging population. Europe is about to. Demand necessarily falls. It's a function of who we are as mortal creatures. It's not a problem that can be addressed by interest rates. So let's take a step back and go back to the analogy. So now we have seen Japan. And I'm not going to draw up the United States. I mean, let me just give you a PCE core. Here's an example. This is PCE core. Hold on, it's coming, it's coming. PCE core in the United States. Cool, it's up there. You know, there's a way that you're supposed to be able to see myself on your screen, but apparently I didn't do something 100% correct here. So next time, by the way, everyone should know, thanks to FX Street, we will be doing a weekly webinar every Monday at 11 o'clock. I'm going to alternate one fundamental and one focus specifically on a currency, which will be both, or several currencies, which will be both a mix of fundamentals, primarily statistics and where the economy, what the state of the economy is, and technicals. So we're going to alternate weeks. 1 week we're going to do a general topic like today, and then next week I'll be doing, I'm not sure what I'll be doing, but I'm probably going to be doing the dollar next week. Since if we're going to start out, you might as well start out with the global currency such as it is. Anyway, so this is a U.S. PCE, both headline and core. Headline is, this is the Fed's preferred number. White is the PCE headline. You get the same chart if you look at the CPI, and the yellow is the core. One of the main differences between the PCE rate and the CPI rate is the amount of inclusion of rental and housing rental costs. They're much higher in the CPI than they are in the PCE, and so the Fed just thinks that this particular method, this particular mix of statistics and information is a better mix. So what do we see with this? Well, I got a serious declining chart. Okay, so let's get a better view of that, a tighter view of that. Okay, this is PCE. Here we go. We're getting better at this. Come on, Google. Right? Google, what happened? There we go. Okay. Now, the question, and I'm going to go right to the theory after this, and then we're going to do a wrap-up. This is American PCE, the same chart, but just from 2010 on. And you can stretch this back a little further. From a bank point of view, what was the U.S. interest rate during this period? 0. Well, 0.25. We all know that. Now, when I mentioned, you know, it's kind of funny that you'll have a lot of commentators talking about this rise in PCE right here, right? They're, oh, we're finally getting some inflation. PCE is going up to 1.67. That's great. If you look at the CPI, it's actually 2.2%, which I think is over the Fed's 2% target. Well, what are we talking about here? Nobody's mentioning this is a base effect. Not the only thing going on, but it's a base effect. This is exactly a year ago. So when this goes down, this goes up. It's not going to continually fall like that. So this is just a base effect on the record of prices from a year ago. It's getting back to this line here. And then this is going to go up like, my prediction, it's going to go up like this, and then it's going to taper off again to the line is here. The question is, does this predict a higher inflation rate? Or is it just reversion to the mean? My guess is it's reversion to the mean. This will go up, and then it will come back down somewhere around the 1.5 line, 1.6 line, which has been going on for 3 years now. So you're unnecessarily seeing it. Okay, so anyway, what's happening through this entire period here? Low interest rates, negative, almost negative interest rates in the United States, and endless quantitative easing. Endless. The 1, 2, and 3. The third only ended ended in October 2014, if I remember. Actually, I have a dead date. Yes, and then we got the first rate increase a year later. a little bit more than a year later. What do we not see in this period? Any inflation. The theory that inflation is a linear relationship with monetary policy has its limits. And this is where we go back to the analogy between quantum mechanics and Newtonian physics. When you change the scale, you get different rules. Subatomic rules are not the same as planetary rules. The weak force and the strong force and all those things my father used to talk about when he would come home from work, because he worked for a university, are not the same as gravity. They work differently, very differently, bizarrely differently. You have a similar effect with interest rates. The linear relationship, just take a very simple example that we can all approach. The linear relationship. The Fed lowers rates on the idea that it will make people, or negative rates, insane. Anyway, that it will make people spend more. But that's not what happens. What happens is they save more. And you can look at the saving rates. Why is that the case? Because when people are concerned about the future, all of us like to save something because we want to have some money when we start aging and stop spending and need to do things. You don't want to be not working with no money. No matter how good the social network is in your country, wherever it is, nobody wants that. So if you have money in the bank, but you can't earn any interest on it, what do? You put aside more money. So negative rates, low interest rates, which are supposed to foster consumption, have exactly the opposite effect. They make people save more because they can't earn anything on what they have saved. And if you know that you need a certain amount of money in 20 years and you're not going to earn any interest on what you have at the time, then how are you going to get to that number? You're going to save more. So if you want to understand, and this is something which the central banks all seem surprised by. The other effect of negative interest rates and low interest rates is they put a serious crimp on business investment. Now, why should that be? The theory is that it's a linear theory. Don't keep the money in a bank if you're a bank at the Fed because you're going to be charged money or earning nothing. Lend it out. The problem is, where do you lend it? To whom, for what do you lend it? If you'd like, again, these examples are right out there in the world. If you want to see what happens to an economy where there's directed lending, just look at China. China has enormous amounts of overdevelopment in all sorts of industries that they're going to have to shut down. You can't falsify the basic price of a capitalist economy and expect it to function or to function well. And that's the other problem that you're seeing. So on both sides of the supposed effect of low and negative interest rates, and this, I think, is back to the analogy of quantum and Newtonian physics. When you change the scale, when you change, for physics, it's the scale. For monetary policy, for economic policy, it's as you get closer to zero. It's sort of like absolute zero. You know, as you get closer to zero, absolute zero, all movement ceases. You have a similar effect. I'm overdrawing the physics analogies here. You have a similar effect from interest rates. The linear relationship or semi-linear relationship that you have between the policy goals and interest rates ceases to function to a great degree at or near zero. And it's certainly true of negative interest rates. They do not foster growth. Okay, we have about 5 minutes here. So I just want to go over, sort of as if I'm giving a lecture here, what we are talking about and some of the analogies I'm trying to draw here. Historically, on the longest scale, prices are inherently stable. It is only the advent of central banks that have put on a bias towards inflation. I will be glad to do a webinar on gold. I love gold because with gold, you get to talk about all sorts of psychology, and that's a lot of fun. And it's very much a pure, it's almost as pure a trading instrument as currencies, even more so, actually. But I'll be glad to do one on, I'll probably do commodities and gold. But that would be a lot of fun. So historically, inflation has been relatively stable, except where it's the longest, 1,000 years, except where it's debased by central banks. Central banks have, especially in the modern era, I know I put a comment out on Twitter a couple of months ago that only the Fed would define stability in inflation as a 2% increase. Now, one thing I haven't mentioned, which is very obvious, but it's a little bit too much conspiratorial, but I'll just mention it. As I have said that central banks have defined deflation as the Great Terror, but they're defining it only by monetary policy. The same is true with inflation. Central banks have decided, for reasons, which I'll explain in a minute, I think, that 2% inflation is a good idea. I'm not exactly sure why. That means in 10 years, you lose 20% of your value of anything. How does that make sense? There is a very good reason it makes sense. And I'll show you what it is. Just give me 1 second here. We're going to end shortly. Just looking for my Fed. Here we go. I have a better, where's my Fed asset chart? Here it is. Okay, hang on. This is coming. This is a good one. It's one of my favorites. Okay, look at this chart. We've got PCE, CPI, core, PCE core in white, CPI core in yellow, and guess what that green line is? It's Fed assets. So this is the other reason why central banks like inflation so much. Every government in the world practically is hugely over indebted. That debt's never going to be paid off. It's going to be rolled over. Inflation devalues debt. You pay it off with debased dollars. And so a 2% inflation rate over 10 years does what? Well, it reduces the debt load by 20%, essentially. Many other things involved. I'm not an economist, I can't tell you. So that's the other reason why central banks like inflation. They may say that government should spend, within their means and all sorts of nonsense. It's not going to happen. So the aspect of inflation and central bank policy and deflation that we're looking at are conditioned more by the possibilities of central bank policy and their tools than by an empirical appreciation of what could happen. Now, the last word I'm going to give you on this is that the Fed raised rates in December. What happened in January? Huge turmoil in commodity markets, in equity markets, all around the world. The Fed may need to raise rates again. Will they be able to? This is no longer a question, and I heard a very interesting man, Ian Shepardson, this morning on the way into work, saying that inflation is headed higher and the Fed's going to have to start raising rates. That may be. And if that's true, and I think it is, then the one conclusion that we can come to, and the ECB should be paying attention to this, is that negative interest rates do not achieve their goals. They are simply the logical extension of monetary policy. Logical that transgresses that zero bound. The zero bound is the analogy between the two types of physics. Things change, and policies no longer have the same effect. Okay, folks, that is the hour. I thank you all very much for attending. I hope I've done everything correctly here as far as the recording goes. I don't guarantee it. We will be doing one of these every week, thanks to FX Street, Adinda and Mauricio. Next week I will have the topic out on Wednesday. It will probably be on the dollar. My email address is available on our site and also on their site. If anyone has any topics I heard from Gold that they'd like me to talk about, I'd be glad to. And everyone have a lovely day wherever you are in the world. Thank you very much for coming. I do take it as a great compliment that people take time out of their day to listen to what I have to say. Thank you all very much, and everyone take care.